All right, welcome everybody. My name is Phil Taub, along with my partner Chris Keefe. We are very happy to welcome you all to. We're losing track, Chris, of how many of these are. My notes say session 24, but I feel like we're at least 30. So a lot of you have joined us before, and what we've been doing since COVID started last March is on a weekly, sometimes every other week, sometimes every third week, have these regular webinars where we're going out into the market, we're getting all-star panels. We have another great one today, finding out what really is going on out there in the market and how that affects your businesses. So really great to have everybody here. All of the sessions we've done before, including the one we're going to do now, have been and are recorded. So please feel free to go to our website at nixonpeabody.com. You can find all of our prior recordings. And Chris will remind you at the end of the program about that as well. So we've been getting a lot of questions from you about workouts, bankruptcies. There are lots of opportunities in restructuring, for example. And so we're going to dedicate this hour to all of that. And we really, as I said before, have an amazing panel here. We will start with Morgan, as we have done many times in the past. Great to have our partner, Morgan Nighan, one of the foremost experts now in all things, PPP and stimulus funds in this pandemic. So let me do a quick intro, and then we'll start with Morgan, and we'll get right into this. I'm very pleased to introduce you to Philip Brendel. He's a senior analyst covering distressed situations for Bloomberg Intelligence. Philip joined Bloomberg in 2014 and has over 20 years of buy-side experience focused in leveraged finance and global macro. Prior to joining Bloomberg, Philip was a portfolio manager at KLS Diversified, covering the firm's credit investments in the industrials and transportation sectors. Between 2001 and 2010, Philip was a director in the leveraged finance portfolio management group of BlackRock. And prior to their merger, Merrill Lynch Investment Managers, where he was responsible for managing many of the firm's distressed and special situation portfolio positions. Before that, Philip held various research and trader positions over 7 years at Tudor Investment Corporation, the last of which was in the distress and high yield space. Philip is a CFA charter holder, received his BS and Master of Engineering degrees in electrical engineering from Cornell University. Also want to introduce you to Joe Sergienko. He is a managing director at BRG. Joe assists clients with risk management and capital planning framework developments, reviews, enhancement, and comprehensive implementations. He also has extensive experience in assessing the impact of regulatory mandates and defining best practices for compliance and business use. And rounding out our panel today is our partner, Rick Pedone. Rick is a partner in our financial restructuring and bankruptcy group here at Nixon Peabody. Chris and I have had the pleasure of working with Rick on many matters for a whole bunch of our clients. He really is amongst the best of the best nationally in this country. He represents distressed companies, strategic buyers of financially troubled businesses, purchasers of distressed debt, creditors and other parties in financial restructuring and bankruptcy processes. Many of the matters that Rick handles involve litigated disputes, allegations of fraud, and insolvency proceedings pending in multiple jurisdictions. So great panel. But we're going to start with Morgan, which we're very excited about. Chris, you get the first question.
Terrific. Thanks, Phil, and thanks everyone for joining us. While I agree, it feels like this may be our 813th NP Connect sessions. Everyone feels like the first one, primarily because of the great guests we have and the interesting topics, and today is no exception in that regard. And before we get into distressed investing and workouts, Morgan, you were with us a couple of weeks ago and talked us through sort of the latest guidance on forgiveness applications and the forgiveness process, as well as sort of second draws for PPP. Has there been any new guidance since we last visited with each other?
Sure. Thanks, Chris. It's great to be here again today. So since the last webinar, the SBA released its interim final rule on loan forgiveness. It wasn't really any earth-shattering drastic changes to the process in that. It basically just updated the prior rule to take into account some of the changes that I discussed last time that were made by the Economic Aid Act but the overall concept of forgiveness works the same as it did before. Basically, the loan has the potential to be fully forgiven as long as you spend it on funds that are permissible expenses for PPP, use at least 60% of it for payroll costs, and you maintain employment levels, which sounds simple, but I'm sure as a lot of the audience has experienced, the devil is kind of in the details with that. So the SBA did release some updated forms. They have a really detailed forgiveness instruction sheet. And so my best advice is to print that out and to review it with care. It's pretty dense, it's 12 pages, but it kind of walks you through exactly what documents you're going to need, exactly how the process is supposed to work. And if you have any questions about how to interpret that, I'm happy to help with that. But that's really the best place to start to understand the nuances is the SBA's instruction sheet that they just released.
Morgan, we're hearing from a number of our clients that they're receiving this SBA form, this 3509 form. Can you remind us what that form is, what it's designed to do, and how the SBA plans to use it in the forgiveness process?
Yeah, great question. We've talked about this a couple times in the past, but it's worth revisiting because it's taken kind of an outside importance. So basically, the SBA is sending this 3509 or 3510 form if you're a nonprofit to any borrower who, together with its affiliates, took a loan over $2 million, because those are the loans that are being targeted for audit. So this form is basically the SBA's first crack at trying to audit the good faith certification of economic need that all PPP borrowers have to make. That economic uncertainty made the loan request necessary, that check the box on the form, that's become really the focus of the audit. So the form is collecting data about what happened financially to the business in 2020. And the SBA put out just one FAQ on this and just made clear that while the relevant time frame for when we consider that cert being made is the day of the loan application, in the SBA's view, they're allowed to consider in hindsight what actually happened to the business to determine whether or not the borrower had the ability to make that good faith cert. So for example, if the SBA learned through the 3509 that a borrower made significant distributions to equity holders, undertook capital improvement projects, or made other kinds of out of ordinary course expenditures, you can expect that they're probably going to follow up and say, how could you have done all these things and still have been able to make that good faith certification of need when you applied for the loan? And if they've said that, if they do follow up, they'll ask for what they're calling a narrative explanation. So you get to basically explain and put some context behind whatever happened financially to the business in 2020. And we've already worked with a lot of clients to help craft that narrative. So definitely reach out if you need assistance with coming up with that.
Well, and it looks like pretty good advice in hindsight, Morgan. I know the advice you gave a few months ago for people to make sure they were sort of clearly documenting that in a memo to the file, and that becomes the basis for your narrative, I imagine.
Exactly.
The last time we talked, you had noted that with respect to loan balances over 2 million, which are the ones that are sort of not subject to that safe harbor, that the forgiveness process is really stalled. Is that still the case? Has there been any movement?
Yeah, so I've now heard of a couple of loans over 2 million that have received forgiveness. So we're starting to see some movement there. But I do know that the SBA, they've flagged a significant portion of those loans as unresolved while they kind of work out behind the scenes what positions they're going to be taking with respect to eligibility. They have an obligation to treat all borrowers equally. So they're trying to figure out, where they're going to draw lines in the sand and what they're going to do with some of these more difficult issues. So although there's been some movement, for some borrowers still may take some time before they hear. The other issue that's going on is that the SBA administrator that was appointed by President Biden still has not yet been confirmed. There was a confirmation hearing, but there hasn't been a committee vote yet. I understand the Senate is busy with some other business that's been all-consuming at the moment, so I don't know when they're going to be able to get to that. But because there's this changing of the guard going on with leadership for big decisions that have sweeping policy implications, I think they're waiting for new leadership to take some cues from new leadership and get some guidance on some of those issues. So eventually there will be movement on forgiveness. So I just want to remind people, if you get any kind of information request, follow-up request from the SBA or the lender, definitely, reach out to counsel about how to craft a response to that and making sure that you're putting all the information that you need to support your eligibility to the SBA. And then, if you do happen to receive an adverse determination on loan forgiveness, if you get your forgiveness denied, you only have 30 days if you want to appeal. So, don't delay in reaching out to counsel if you do want to prepare an appeal for that.
Morgan, thank you as always for joining us. I know that if anyone else has questions here that's listening in, please use the chat function and Morgan will try to address them, or just email any of Morgan, myself, or Chris, outside of this, and we'll get you on a phone call with Morgan and get your questions answered. So Morgan, thank you again.
Yep, happy to help. Thank you.
Thank you. So Philip, we'll turn to you now. And again, Phil, thank you for joining us today. We got you on mute there, Phil. You got to just unmute.
Thank
There
you.
you go. There you go.
Thanks for the opportunity.
Yeah, no, it's great. And so when the pandemic first hit, Phil, tell us a little bit about what your expectations were and how that played out and sort of what surprised you.
Sure. One of the things that I look at is distressed supply, and how I measure that is I look at the inventory of distressed bonds in an index. It's the ICE Bank of America Merrill Lynch U.S. High Yield Index, because that's going to capture most of the corporate bonds. And when you think of defaults, it's usually going to be high yield bonds that are more likely to do that. The index has a deep history. So going back to the beginning of 1997, I looked at this index a number of times trying to catch the troughs and peaks of the credit cycle. And what we call distressed is really any bond with over 1,000 basis points of spread over the Treasury curve. That's the traditional definition. Well, March of 2020 was a horrific month for credit, as everyone can imagine. And at the time, it appeared to us to be the beginning of an economic collapse that might even surpass the Great Recession. Each sector had double-digit distress ratios, led by energy, where 85% of the bonds in this high-yield index were distressed. Overall, 29.2% of the bonds were trading at distressed levels. And to give you nominal terms, 366 billion, excuse me, of the $1.26 trillion of debt in the high yield index were trading at distressed levels. And within March, the highest peak was actually the third week of March, because it already started to rebound within the month. And that was at 44.5% for the whole index was considered distressed at that point. And that reached a level of $559 billion of bonds. To put that in perspective, the peak of November 2008, the Great Recession, that was $644 billion. And that distress ratio was 86.1%. So I just threw a lot of numbers out there, but it clearly, this was the velocity of this move was shocking. We remember that the Fed came in, there was talks of fiscal packages that weren't necessarily done at the point. But at that point, I believe that because the roots of this recession were in the real economy, that we were getting this massive economic shock, and companies react as companies react, as opposed to home building or the financial institution collapse that we saw in the Great Recession, that we would probably see even larger numbers, in terms of distressed debt and defaults. However, that was completely wrong. And, that's largely due to the flood of fiscal stimulus, the sharp drop in interest rates, massive job cuts, which actually preserved cash within these businesses, and extended and extra unemployment benefits, which helped with stabilized spending. Nevertheless, lower consumer spending because everyone's at home, led to higher savings rate. The fiscal stimulus and near zero rates led to cash chasing publicly traded financial assets, all of it, bonds, syndicated loans, and equities. And what I found fascinating about this is issuers really took advantage of this, the financial asset, inflation, you can call it. Now many issuers are sitting on massive cash hoards. The operations necessarily haven't turned. You have operation cash burn, but it's taking time, and they actually have cash to do that in. And they were ultimately fortunate to be able to access capital because investors are effectively viewing this as one giant non-recurrent item. And it should be noted also that most of the issuance in the public markets was in debt. Equity is definitely tougher, but there are great examples of equity issuance as well. So.
Phil, you mentioned energy as you started talking to us about the landscape when the pandemic first hit. What comprised the distressed landscape in the beginning, and how has that shifted over the course of the year during the pandemic?
Yeah, sure. So energy was, like I mentioned, it was 85% right off the bat. And I think the market got it right. Consumer discretionary, about a third, 31% to be exact, of the bonds in the high yield index that were consumer discretionary. They were distressed, and then the other big sector was industrials, that they were going to take a hit as well, and that was 29%. The only one that was under 10% was at 9.5%, and that was utilities. Now, as we fast forward to today, and really, to put this in perspective, it was really just 1 month of massive distressed supply. It got sopped up, and I think I certainly was one to think that we have seen where the Fed reacts, the government reacts with these stimulus packages, and the markets get ahead of itself, and then they fall back. In fact, we saw that in the Great Recession. And so, I, for one, thought that maybe we were going to see that again with the economy, but really it's been nonstop improvement. And, there's a technical momentum that also picked up. But to fast forward to today, that 29.2% is now down to 3.5% overall distress ratio. The only sector to speak of that's in double digits now is energy at 13.4%, and that accounts now for 53% of all distressed debt. So this has the profile that we're familiar from, like the 2016 cycle, where it was really when you talk distressed, it was really just energy and idiosyncratic credits. We're seeing a lot of that. That's sort of the sector profile as it is today.
Philip, I understand that you've done work on American Airlines. Love to hear your thoughts on how you think they've handled the pandemic.
Sure, absolutely. So American Airlines, one of the things I do, I look at a lot of credits that are, bankrupt or near bankruptcy. Those are kind of the obvious ones. But American Airlines, I wanted to look at because they were clearly, the most levered legacy airline and not only that, but they're right on the forefront of like companies and industries hit by COVID. Well, so what I was thinking was that they'd be in trouble quickly and sort of realize that the best thing for them is to go into bankruptcy, where you could reduce scale and size pretty dramatically. But here's a good example of a company that took advantage of all levers available to it. The company's operations are currently burning about $30 million a day. It was a lot higher during the summer. I want to say, probably between 50 and 75, during those first early months. So even at 30 million a day, that's about $3 billion a quarter. And so what they did was, and some of these levers were clearly the government jumped in and supported them, which, for most people who are familiar with bankruptcy, airlines are always in bankruptcy. And not only that, but Chapter 11 provides airlines tremendous capability to, reject aircraft leases and do a number of, and restructure union obligations. And American still has significant pension obligations. But nevertheless, the government provided incredible support for these airlines. American Airlines collected $6.4 billion in grants. The government lent it $2.7 billion in unsecured promissory notes. $7.5 billion is available to it in secured term loans. And then they did a significant self-help. They raised $4.1 billion in equity raises, which is pretty incredible when you think about it. And I think a big part of that is because the company was able to, because they had these grants, the equity market cap which stayed up, and the company wasn't shy about it issuing equity. In fact, the 4.1 billion is including an at the market equity raise that they, just filed in January. But nevertheless, so what they did was they built this big cash hoard of liquidity, and at the end of the first quarter, they expect that to be around 15 billion. But the other side of this is that your debt increases significantly, and the real question becomes when we get to the point where people are getting vaccinated and feeling comfortable traveling again. The amount of debt that's on American Airlines will be so much that will the value of the company itself and will post-pandemic cash flows be enough to support that kind of capital structure? And so, just generally speaking, the question that's out to them is sort of the question on a lot of these businesses. Will the value of your company be able to be such that you can overcome all the debt that you put on to fund operating losses during the pandemic? And that's why these vaccinations are so important, because and just ending the pandemic, because it's incredibly, when you're funding operating losses over a long period of time, that's a lot of debt that you're incurring.
It's a perfect segue into my next question, which is, look, I think before we had this, this is the first time I've heard the pandemic described as a massive one-time event, but I like it because it gives you some certainty that things are actually going to be over. But even before we got into this massive one-time event, we were in an environment where I think everybody expected some sort of increase in the interest rate environment, in the medium term. Obviously, all the spending that's being done and the capital that's being infused into the market is just going to exacerbate that at some point. So where are we in the credit cycle, and when do you think when do you think things might turn?
Yeah, so usually these credit cycles have long legs. This one's unusual in that the downturn was effectively a month. The cycle really outdid itself in how quickly it came back. For instance, the last credits upcycle was May. It went from May 2016 to actually September of 2019 is when we kind of peaked out. The distress ratio hit its lows, but it started rising, but not a spike until we got the spike in March. But that was sort of an exogenous event. But as I think about this cycle, I think that just like the hard part was very short. I think we were at the extent, when it hit, we were already an extended credit cycle. And what I almost think is happening, what we're setting up for is, with all the fiscal stimulus, with all the monetary stimulus, we have a lot of supports, a lot of legs underneath the stool. And as these start coming off and companies have to stand on their own, I think that's where we might, the tire might hit the rubber might hit the road. And that's where we might start running into trouble. There's a trader, a lot of traders use the expression, you buy the rumor and sell the fact. And, that I think that kind of fits this narrative here that we're seeing, where like everyone's expecting the end of the pandemic. Everyone's like counting on it, but we have all these legs supporting us right now. But, once we actually get to the point where, there's no further stimulus, rates are poised to go higher. Anyone who wants a vaccine can get one. And, cash hoards, are starting to be depleted, are getting near depletion. And maybe the bounce back economy disappoints. maybe that's when we really see a pickup in restructuring. Because as I understand it right now, there's not a whole lot, and I see that possibly being in the back half of this year.
Well, Phil, thank you for all of that. That was really great, and we're gonna segue now to Joe. I'd be remiss if I wouldn't just mention, with all the great panelists you've had, you were the first Philip we've had, in all of these months. So grateful for that.
Yeah,
I don't know how that happened. We went that long, but
I enjoyed that too.
thank you, Phil. And Joe, I did not mention that you and I share Boston University as an alumni when I was introducing you. But thank you for joining us here today, Joe.
Thanks for having me.
So, Joe, we want to switch gears here a little bit and focus on the bank's perspective and get some insights from you on that topic. Let's just start with something fairly basic. Help us understand what is a bank's motivation to restructure a loan?
I think the first motivation is quite simply to maintain the relationship with the borrower, right? These loans are very profitable long-term relationships. And so rather than just write off a loan, they want to restructure it to keep the relationship on the books and keep, to some extent, the borrower happy. That there's an element of altruism here where you assist the borrower and, so that the debt load is not overly burdensome and they can repay their debt and run their operation. And particularly in times like we're in now, there's some element of let's just all be in this together and everybody's going through a hardship. So let's try to be somewhat accommodating. And, Morgan hit on it a little bit with the SBA loans and the forgiveness process that the government has. We're seeing some of that with banks and their willingness to work with clients and restructure loans. I mean, the other element here is the less altruistic element, which is they want to ensure the bank is made as whole as possible, right? They put a loan on the books for $1 million. They want to get as much of that $1 million as possible out of a business that has economic value. And to restructure that debt, it might mean elongating the term, it might be reducing the interest rates, but it allows them to maintain the relationship, get as much as whole as they can, and allow the borrower to maintain their operations. I think that's why we enter restructuring, and then you kind of go from there in the process with the borrower as to what makes sense to maintain economic value in the relationship.
Joe, I think it's an interesting point you raise, because I think the banks in general, I think, have shown a remarkable degree of restraint, but even with all that restraint or altruism, if you characterize it that way, there are some points where you just have to move something from a restructuring to a workout. And sort of what's the thought process that a bank goes through in driving to that decision?
I think what drives that decision most of the time is they're increasingly concerned that they're not going to see that economic value return in the business. They're seeing some softness, whether that's delinquency in payments, that's some economic condition like this one-time event, as Phil mentioned. It's just not likely this business is going to be able to return to full repayment of the loan. It's not, a lot of people, when they enter into a workout, they tend to think, oh, the bank is just being mean, or they want to end the relationship. That's not generally the sense that bankers have. They really are seeing some softness, and they want to get to a point where there's a plan in place where they can, again, make themselves as whole as possible. They're a little probably less concerned about the relationship of the long-term relationship to an extent. And they want to be sure that they understand kind of the story behind why the loan is in delinquency, or the economic conditions are unfavorable to the borrower. Yeah, I do think, though, in entering workouts, banks are not necessarily looking to sever the ties, but they are looking to have a more kind of robust discussion about the underlying fundamentals of the business and how they're going to get repayment, rather than just kind of sit and hope.
So, Joe, talk a little bit more about the workout process, if you don't mind, right? And you know what the bank is looking for and how that process goes. We've seen with our own clients some of those processes actually go quite well, right? And unfortunately, some of them don't. But help us understand a little bit more about that.
Yeah, I mean, I think one of the things as you're entering in a workout process, you kind of have to think about the bank's perspective when they're underwriting a loan, right? There's a risk in any lending process. And banks, as they risk rate a loan, are setting aside capital to service that loan, and that's a cost to the bank. There's also elements of cost as you're servicing the loan, and as the risk of that loan not being repaid increases, the more cost there is in the workout process. And so when a bank is entering the workout, they are trying to limit those expenses as much as possible, right? They want to get to a resolution, whether it's positive or negative, as quickly as possible. And I think what as you're going through these processes, you need to remember is there's two sides to every negotiation, right? And the risk the bank has is a monetary risk, and losing money is never high on anyone's list of things to do. And so what they are trying to do is collect as much as they can and reduce the bank's cost in terms of capital and actual line item income statement expense to limit the amount that they have to take a hit on the balance sheet or income statement and report EPS declines.
So Joe, Phil and I talk a lot in our practice with our clients about prepping our clients for sale, putting them in the best position to get the sort of the best bid on the table, and then also to sort of work through the process in an efficient way and confidence building way for their prospective buyer on our sell side transactions. What are some strategies that you've seen that help make a workout process successful for a borrower, and then on the other side of the transaction, the bank?
Sure. So I think from a borrower perspective, and the legal eagles on the call may disagree, but I tend to think being as open and honest from a borrower perspective and putting the story out there, and to some extent, to go off of what Morgan said on the SBA side, what's the narrative? What's the plan around the business to get it back to being current on its loans and being economically viable? And telling that story to the bank can really help them rally around your cause at the end of the day. I've been involved in some workout discussions where people are holding things too close to the vest, or they're trying to spin the story a little bit too much, and banks are going to see through that, and it's just going to make the bank a little less movable in terms of working with you and figuring out the best way forward, whether it's a workout or restructuring. I think if the borrower puts those cards on the table, as it were, you're going to have a more open and honest discussion about moving forward. From the bank side, I think what they need to do in a bank, you tend to have the originating lender and then a workout lender if you move into workout, right? And the most successful workouts that I've been a part of are going to bring the originating lender along with the workout team, and really, because the originating lender are the ones that understand the story from the beginning. This is why we made this loan. This is why we have this relationship to begin with, right? And the workout lender is looking at it slightly differently. So you bring them together and you can have an honest dialogue of, really, this is the true economic value of this business, and we are going to get what we need back. And this is how we can work with each other. If it's just, let's just get our money back, then the bank is going to probably not recoup exactly what it thinks it should be able to.
Joe, I agree with your advice on just being open and honest. We've seen that play out many times ourselves, right. There's almost this natural inclination to play things kind of close to the vest, right? And I think that's just human nature. But it's, I've seen where, if there is trust built between the new sort of restructuring team at the bank that you're dealing with and the team that's in place to sort of manage the company, and that trust is usually based on an open, honest relationship, it tends to go much better. Just look, it wouldn't be in restructuring if there weren't some issues. So you just be as honest as you can about it and put it all out there. And, banks tend to behave in an economically reasonable and rational way, right, as opposed to an emotional way. And that's, that tends to lead to better decision making at the end of the day, right?
Oh, absolutely.
Yeah.
I think if you put forward a plan and show the economic rationale as to why they should continue the relationship, you have a much better dialogue and conversation and opportunity to maintain that relationship and, not have to pay out of your nose to the bank at the end of the day.
Yeah, no, that's right. And, workouts doesn't have to necessarily, be something to be embarrassed about or ashamed of or whatever. There are lots of opportunities for a business to sort of work through some stuff. Sometimes, the workout is maybe forced upon a company because we had this event like a pandemic, or sometimes it is mismanagement or a big lawsuit or whatever. But it's an opportunity to work through stuff. And in my experience, and Rick will talk about this, I think, in a little bit, it tends to, if it's a well-run process, to be a better alternative than, for example, going into bankruptcy, right? And having the bankruptcy rules apply and the microscope of many lawyers and the judge and the trustee and all of that. So, encourage folks to be thoughtful about the workout process. We've seen a lot of them do very well. I wanted to see if there's anything else from the borrower's perspective, that you would like to share, is, if they find themselves in a workout, what else should they be thinking about?
I think, putting together the plan of, ideally, if you're going to work out, there's an element of, I want my business to succeed. I don't want to head into bankruptcy. I want to work myself out of whatever situation, whether it was driven by the pandemic or what's driven by a lawsuit, as you said. There's a reason you're in business to begin with, and you want to maintain that. So putting a plan together to articulate how you're going to do that, and that needs to include kind of a cash flow analysis of, here's where I expect to receive cash, and here's how I plan to spend my cash, and here's how we're planning to grow the business or wind it up, however you want to work through it. I think pulling that together and thinking through those sorts of questions that the bankers are naturally going to ask when they're looking at a business and being able to work with you on your debt, whether that's in restructuring or workout, saying, hey, look, this is how I plan to expand my business over time as we end the pandemic and people start taking taxis again. I'm going to be able to expand my fleet, and here's why, and here's how I'm going to do that, and put some analysis behind it. Obviously, law firms, consultancies can help with that, but you're in business, you're driving the bus, so to speak. Put that on a piece of paper and talk through it with the bankers, and I think that goes a long way to articulating your vision and gives them some comfort that this is an ongoing concern that they can rally behind and help you through the workout process.
Well, thanks, Joe. Appreciate that perspective. I think a lot of our clients, hopefully, not all of them, but a good number will find that be valuable advice for themselves and for the people in their supply chain over the course of the next year or two. So we wanted to turn to Rick next. Rick, where I grew up, someone with the level of experience that you've had in the space, we would say, yeah, that guy's seen some stuff. You've seen a lot over the course of the last few years. What's the most surprising thing that you've seen occur in a bankruptcy since the pandemic began?
So, Chris, if it's okay, before I turn to what's the most surprising, which was a really surprising event, I want to echo a couple of points that Joe made that I thought were really good. And that is heading into the workout process, you need to establish a trust level. And the pandemic's a little bit different in that it's a no-fault event. You have this great cover of an event that affected everyone. So your lenders are actually going to be looking to find a way to trust you. And that comes through appearing candid, making it not look like you are hiding something, thinking about how you can act so that that lender's representative feels that they're dealing with you and they will never look like a fool for having believed you and dealt with you. And then create that narrative that can go forward. And part of that comes from picking advisors who are trusted by the banks and start with the trust. And then part of it comes from how the borrower behaves. And so I thought those points that Joe made about the narrative and trust were really important. So the most surprising event, early on in the pandemic or midway through the pandemic, I was representing US Bank and still am as a member of the creditors committee in the Hertz bankruptcy. They had a large bond issuance. And lo and behold, one day it was announced that Hertz would actually, instead of borrowing under a DIP loan in bankruptcy, would issue stock. And here we have a bankrupt company that for a period of time clearly met the one definition of solvency, in that its equity had value. And that equity was bouncing around from $1.50 to $3 a share. And I have to say, I was pretty floored by the fact that you didn't need to borrow money using the bankruptcy mechanics. You could issue stock. I was equally surprised by the SEC didn't complain about it immediately. We actually went through a court hearing with an SEC representative there and got bankruptcy court approval for that sale of stock to go. And then the SEC, a couple days later, after it made headlines, woke up, I think would be a fair way to say it, and began to question how this could actually be done with the existing rules. But it was really foreshadowing the GameStop phenomenon that we see today, what has occurred with AMC and some of their equity value. We had the incredible occurrence in the past few weeks where someone holding convertible debt in AMC, a theater company with clear cash problems, chose as an exit strategy to go ahead and convert their debt into equity and sell their equity in the middle of a pandemic for a movie theater chain. And AMC continues to manage to issue some stock in order to stay afloat. So I think that massive liquidity that ultimately is driven by the government here and just an unusual market is the most surprising event. And it creates opportunities for restructuring that some of us never imagined could exist before. And people should be thinking creatively.
And Rick, Hertz didn't think to buy a massive amount of Bitcoin to push those shares up. That didn't occur to them.
No, they're leaving that to a particular auto company that is long on the future of electric cars.
Yeah, and there are hundreds of other publicly traded companies that are following suit right now, I think. So that strategy worked for one company. A few others are going to try as well. So yeah. Crazy times in the stock market.
I'm just happy I missed out on the GameStop thing because all my money was in tulip bulbs.
Can I jump in? Rick's point was so great on the AMC, that convertible. If you take a look at a price chart, they actually converted it at $13.50 and sold all their shares at $16 or thereabouts, and removed $600 million off of the company's capital structure, which is just incredible, an incredible result for the issuer. And it just points to like how nimble you really need to be. You really have to be kind of always thinking about this. I mean, GameStop might be, sort of late here in trying to take advantage of this stuff. But I thought that was incredible.
Yeah, no, it sure is. So Rick, let's go back to you, and I want to ask you about companies that are in travel, tourism, and entertainment, right? And tell us, how they're surviving and what strategies they're employing to survive.
Yeah. So, to touch on the point that I began earlier, this is a no-fault event. And so unlike a lot of scenarios where an industry may go down and has borrowed too much money, this was a shock to virtually everyone, certainly not everyone, but close. And so as borrowers begin to deal with their creditors, there's a lot more flexibility on the part of the creditors and how things are getting dealt with, and a lot more patience. So very few banks are coming in and pummeling lenders. very few borrowers, very few banks are selling positions cheap, and the debt is not ending up in the hands of loan-to-own vultures in as many instances as occurred in the past. And I use that term with endearment to my clients who employ that strategy. And so it's created a very different environment where there's more flexibility. So on the entertainment side, we have what AMC has been able to do. Similarly, the massive flood of government money. I have a theater industry client that found themselves eligible for a Main Street loan, and from heaven came millions of dollars. And there's now the grant program for opening up shuttered venues for live performances that may also keep the industry alive. And that's $15 billion of money that's going to flow to venues. And so that's one tool that's being used. And it may not be enough money, but it's keeping them afloat. And then, you know, we had a travel company that we represented that had a pile of customers who weren't able to travel, 7,500 customers, tens of millions of dollars in bank debt. And the question was, how can this travel company survive? What could be done? And in that case, given the enormous number of consumer creditors who had to be negotiated with and brought to the table, we actually had to use the Chapter 11 restructuring process. But having worked through some cases, what I was able to say to the lender and to the company was, in this environment, we can get through bankruptcy very quickly because it's a no-fault scenario. And in less than 60 days in bankruptcy, having done a prearranged plan, we took that company into bankruptcy, offered credits to the customers, basically did a debt for equity arrangement where the private equity owners gave some of the equity to the lenders. And we came out of bankruptcy with a restructured company and a clean balance sheet poised to frankly boom in the coming months as travel resumes. And so that's one way that folks are dealing with it.
So Rick, you and I have talked on a number of occasions in the past, both with respect to companies that might be facing insolvency or just companies that are struggling, and you know, directors and officers start thinking about things, thinking deep thoughts in those contexts, and thinking about their responsibilities to their companies, to their shareholders, to other constituents. In a few minutes, sort of give us a sense of, you know, of what you tell officers and directors when you sit down with them in that context.
Sure. So when you're responsible for a company that's facing a financial cliff, everybody thinks, how can I get out of here? And everybody's thoughts go to, where do I have to be honest? What do I actually have to disclose? What can I get away with? And frankly, many people think very aggressively about it. But what I always say to directors and officers is, okay, step back, let me explain how the law looks at this. Many people talk about shifting duties during a zone of insolvency. That's not quite accurate. Directors and officers always operate with a duty to the entity. It's just who benefits from the entity's value in an insolvent situation, and it's the creditors, and it's the creditors benefiting who may bring claims later. So I say you have to stop and think about what you're doing, and does it actually benefit the entity? And I always use the example of, don't go and buy a lottery ticket for the company with the last dollar, because that's not a business judgment rule test. The standards remain the same. And then I also say you need to be stopping and thinking about, is the best thing for the creditors taking the company through Chapter 11? So in our travel industry case, where we knew we could find a way to give credits and spread it over time, had that company the directors allowed that company to crater when a viable plan of reorganization was available and could have occurred, that diluted equity considerably, but preserved something for all those creditors, it could have faced the directors could have faced claims straight on. So my advice is, get yourself a professional and then apply the standard business judgment analysis that you always do in this unusual circumstance, so you realize what the opportunities are. And frankly, it often involves making sure you know what will happen in bankruptcy so that you can decide why you went that route or why you didn't go that route and defend it later.
Thank you, Rick. You know, Joe gave us some great insights on, you know, the lenders and how they approach workouts. Wanted to ask you a follow-up question about that, you know, which is, you know, based on your experience, how do lenders manage workouts without actually fully taking control of the business?
Right. So here, for what a lender needs to be thinking about is that they don't want to exercise that operational control and be responsible, so they're not perceived as becoming essentially a fiduciary to the other creditors or improperly exercising control. You don't want to step into the director's shoes. You may know the exact route that you believe it should go. And the way that lenders can exert their control without actually doing it and becoming responsible is frankly to bring in a professional in most instances, and you say to the borrower, here are my remedies, they are catastrophic. If I put the company into a receivership or I begin to foreclose on my collateral, instead of doing that, why don't you hire a consultant? And here's my list of 3 consultants such as Joe that you should consider hiring. And by the way, I've put them in order of what my favorite ones are. And you use lots of subtle ways to drive the borrower and block the borrower from going where you don't want them to go. And frankly, lenders should also be acting with candor because they're trying to build the borrower's trust that the outcome is going to be mutually beneficial for both, and it's not going to be a zero-sum game.
Rick, in the context of the pandemic over the course of the last year, have any of the rules or laws with respect to the insolvency process been changed to ease the process or otherwise adjust the circumstance?
Right. So there's 2 things. First, as we've touched on, in light of the fact that it's a pandemic and bankruptcy court hearings are taking place by Zoom, and things are going more quickly, restructurings, I believe, now can be done with less expense and more ease to get through a full Chapter 11 than I would have told a client they could have been done 2 years ago. It is a lot cheaper for 100 lawyers to participate in a Zoom hearing, as we did in the PG&E trial for confirmation last spring, than it is for 100 lawyers to descend on San Francisco and show up at court every day. I've had multiple instances where it's easier, it's faster to take a company through than it used to be. So that's the first thing, which isn't the result of a rule change. The other thing I want to make sure everybody's aware of is subchapter 5 of the bankruptcy code, which is basically a small business provision of the bankruptcy code, which allows you to get a company with roughly under $7 million in debts through a Chapter 11 process without the need for a disclosure statement. It's easier for equity to retain their ownership. And it can go really, really incredibly fast and more simply. Now, granted, most bankruptcies aren't involve more than $7 million in creditors, but if you have an entity with a small subsidiary or a small company you're trying to figure out what to do with, make sure that you check and see whether or not subchapter 5 could apply.
That's terrific, Rick. Thank you.
You're welcome. Thank you.
So we'll throw this out as a jump ball with the few minutes remaining we have left. In terms of restructuring, do you see sort of overall loan covenants sort of moving in a particular direction?
So I'll take the jump ball first and then throw it back out there. I think some banks have eased the loan covenants to an extent, given the to use Rick's term, the no fault nature of the pandemic. They've eased some of their requirements. And those are more on, some of the more paperwork style covenants that you've seen. They've kind of lessened the requirements. Some of the ones they're still trying to hold to them as much as possible. But as we mentioned earlier, they are having, as long as you're having dialogue around why you would be not meeting the covenants, I think lenders are able to listen to those and give dispensation for that.
So I'd say in the mid-market and lower mid-market, I actually describe it as a tidal wave of waivers on the part of lenders, because lenders don't want to take the borrower out and shoot them, so to speak. They want to see what's going to happen and do things settle out. I'm involved in a couple of matters where now it's getting to some real negotiations over covenants, and I'm curious if with the end in sight, and this is a couple of businesses in the travel industry, if we're actually going to see a change. But for now, I'd say there's been tremendous flexibility, in part because the lender does not believe that there's a better option at this point in time.
Yeah, I'll just comment it a little bit here. Just generally, as I remember working out BlackRock CLOs at one point in time, and just the CLO community, they really do not want to have to deal with defaults. So it was they almost hated the default more than the companies to a certain extent, because it just puts it into a different bin, a different category. But generally speaking, the revolving banks think about it differently, as Joe pointed to. They have the relationships with the lenders. The other thing is that, in a lot of these, when they are interacting, they don't want to be visited again for the same problem, which is the pandemic. I noted a number of radio companies that saw the big drop in EBITDA. They had covenants, and then they basically put in, let's pretend that we made last year's EBITDA into the covenants, into the covenant calculation, which is okay. It's like we don't really want to deal with it. So it's a lot of people just want to bury their head in the ground and come out once the pandemic ends.
Well, we got time for one more, and then we'll wrap up.
I think we do, and I liked. We got a question that came in from the audience, which I really liked, and I was wondering the same thing. So here's the question. So, as companies are closing down locations and merging various locations, the question is, what's happening to all this excess collateral? Whether that's furniture or computers or IP. What is your sense of what's happening to all of that?
So I've had a couple of businesses where the collateral is literally in storage and is going to get thrown away because it's a big pile of office furniture with no market. And we're repeatedly having discussions in the entertainment space and travel space about, okay, what's the stuff worth? And there's no market, and it's a wipeout, including things valued at a lot of money 2 years ago. So that's what I'm seeing. There's a market dislocation and a reluctance to put a lot of it up. I don't know what the others are seeing.
I think there's a lot of wait and see. Do we need it eventually? And so keep it in storage for a period of time. There's nobody buying it anyway, so keep it in storage. And if we decide to reopen a location or the market reopens and there's a need for it, then we can sell it. But for right now, it's just, as Rick said, kind of sitting around doing not a heck of a lot.
Yeah, just add, when I read in the Wall Street Journal about all these Herman Miller chairs being sold, I actually took advantage of that and picked it up. So I know some of these office chairs are showing up in warehouses and then being sold to folks at home. But the other interesting part, in Chuck E. Cheese, in that bankruptcy, I followed it, and there's a ton of abandonment motions that we just want to leave everything there, and it becomes sort of the landlord's issue to dispose of it, which I'd read as mostly thrown away. I don't know how many of those habit trails that can get resold, especially now.
We'll see if it starts a trend. The next cover of Architectural Digest will have a dining room table with 10 Herman Miller chairs around it, right? So it could be a new design trend. Well, Phil and Joe and Morgan and Rick, thank you so much for being here with us today. We have very quickly come to the end of our time today, and we want to thank you, each of you, for bringing a lot of insight and experience to the table, and we know that everyone listening has benefited from it. So thanks again for being here.
Thank you.
Thank you.
Well, everyone.
Thanks for having me.
So in addition to today's webinar series, we've been holding a variety of timely programs across many areas of interest. Please join us on Wednesday, February 17th for our Vaccinating the Nation program. What You Need to Know webinar will feature legal questions and challenges regarding widespread vaccination and vaccination at scale. And additionally, you can join us for a new installment of our NP Let's Talk series coming up on Wednesday, February 24th We'll be featuring Ariella Suster and Jamira Burley, who are social entrepreneurs, activists, and co-founders of I Am Here To, which is a community dedicated to turning personal struggle into a force for good. We're thrilled to sit down with Ariella and Jamira to hear about their career journeys and their life experiences that led them to where they are today. You can access past recordings of this program, as Phil mentioned, at the top of our hour, and you can register for upcoming programs and subscribe to mailing lists on our website, nixonpeabody.com. Thanks again for being with us today, and we'll be back in a couple of weeks.